All right, so why don't we go ahead and get started. I just wanted to thank you all for joining us today for our Financial Planning Masterclass. My name is Jackie Martaccio, and I'm the Director of Engagement here at NEC. I would like to welcome Elaine Grogan Luttrull, who is the founder of Minerva Financial Arts. And with that, I will turn it over to Elaine to begin.
Thank you, Jackie. I appreciate it, and welcome everyone. I am really excited to be joining you to have this conversation today. As David just mentioned, we are coming to the end of a very strange year. And so in normal times, we'd be talking about financial planning and some year-end tax strategies. And that's a good thing to be talking about now too, because things are really complicated right now when it comes to your money. I'm sure you're all probably familiar with the Zoom platform by now. I think we've all become experts, but a quick refresher, go ahead and keep yourselves on mute just so we can minimize any background noise. And if you click on the participants button, you can see who's here, and you can also change your name and add pronouns to your name if you'd like to do that. And then you can also use the chat feature to send messages to me and the other hosts during this program. I will keep an eye on that during the presentation, so that's probably the best way to get your questions in as we're going, and then we will definitely have some time at the end for questions. Thank you as well to all of you that submitted questions in advance. I've incorporated them into some of the content we'll go over for today. So as Jackie mentioned, my name's Elaine. It is lovely to be here with you. I am a CPA and a personal financial specialist. So that's the investment and budgeting and planning side of CPA world, in addition to the tax world. And then I am an accredited financial counselor. And I have the very great privilege of working with creative groups all over the country and helping creative individuals and organizations with the business side of creativity. So I am absolutely the luckiest CPA ever to be doing this work. And this work is educational in nature. So even though we're talking about taxes and investments and financial planning, none of this is to be construed as tax, legal, or accounting advice in the technical sense of the word. So what are we doing? Obviously, we are talking about money, but more specifically, I thought we would spend some time going over the current status of some COVID-related assistance. That will be a very quick conversation since we're not really sure if more will be coming. And then we'll plan proactively for the rest of this calendar year, and then begin thinking about planning for 2021. I think we know in some ways that effects of the pandemic will certainly continue, especially economic effects of the pandemic, but we also know that there are some things we can be doing to kind of manage some of those effects and remain as optimistic as possible. So as I mentioned, the stimulus update is going to be a really quick one. As of now, we do not have any additional stimulus at the federal level in the United States. Our elected officials have returned to Washington, and there are some conversations happening. It looks like there might be an extension to some PPP dollars, but it does not look like, at least based on what they're discussing now, there will be another one of those stimulus payments. That's that $1,200 amount. All of this could change in January, as you know, so we will just continue to keep an eye on it, but most people are not planning to receive any additional federal dollars or state support dollars, which means we're focused instead on planning and really focusing on the rest of the year. So a lot of the conversations I've been having are around this idea of now is really a good time to look at what 2020 has looked like for you financially. And I will say there are some individuals in the arts who are really struggling. They have earned considerably less income than normal. Grants have not necessarily come through, and many of their expenses have remained the same. There are others in the arts who are doing okay, right? Whether they have received some stimulus money or emergency relief funding, or if they've been able to effectively migrate some of what they do into an online environment, whether that is teaching lessons virtually or whether it is performing, especially in a chamber group or small group setting virtually. There are a lot of creative individuals that are still making some money. So because there is such a range of how people are doing financially, now is a good time to check in with your own numbers. And this is much more complicated than it seems. So this is maybe what it would look like in practice. What I've shown here on the slide is basically a summary of different types of income or cash payments you may have received this year. And then we've got some expenses that you may have had as well. And as we're going through this, on the income side, the big question is going to be, is this taxable or is it not taxable? Because as you're doing your year-end planning, the big question we're going to focus on is, what does your taxable income look like for the year? And if it's going to be higher than normal, we want to maybe do some planning to contribute to retirement or take some steps to kind of bring that number down. If it's going to be lower than you expected, then we want to really focus on keeping excellent records and making sure kind of all of the proverbial ducks are in a row, if you will. So that's kind of what we're thinking about. And I'm going to walk through each of these and highlight a few things to pay attention to in each one. So let's start with PPP. PPP was the Paycheck Protection Program, and this was passed as part of the CARES Act way back in the spring. And what this did is it provided about 2 months worth of income to businesses and individuals who were running their own businesses. The amounts you may have received were based on numbers from your Schedule C. That's your individual tax form that reports your business expenses from last year, so from 2019. And the way this program was structured, these dollars initially went out as a loan, but they were designed to be a forgivable loan, which means then it essentially turns into a grant, which is good. We like grant dollars because you don't have to pay them back to the Small Business Administration or the bank that funneled your PPP dollars to you. Odds are, if you received PPP dollars, those are not taxable to you, either because they have already been forgiven, depending on the size of your loan, you may have already gotten that forgiven, or because it is still structured as a loan to you, right? So you probably don't have to include this number in your number of taxable income. Again, because it's probably going to be forgiven and excluded from income, or it's still classified as a loan. The other big question that is coming up with PPP is whether you can deduct the expenses you paid for with PPP dollars. And I'm going to apologize on behalf of the tax profession right now because this gets a little dense in terms of the conversation. But let's pretend you received $10,000 in PPP funding, right? You took that $10,000 and maybe you spent a portion of it on rent. Maybe you rented a studio space to record or perform or do lessons, right? So you had some rental expenses. Maybe you had some utilities you paid on that rental space. And then maybe you paid yourself a salary or some form of compensation based on last year's tax return. Those are all things you were allowed to do with your PPP dollars, right? So when Congress passed the legislation that included PPP funding, they intentionally said these dollars should be excluded from income once they're forgiven, meaning you don't have to pay taxes on that $10,000 you got. And you should still be able to deduct your rent expense or utility expenses, all those ordinary and necessary business expenses that you use those dollars to pay for should still be deductible. So that's how the language in the original CARES Act was presented. And we see that from the legislative history. Now, the IRS disagrees. They say, and they came out with some guidance that was very, very clear and definitive towards the end of last month, that if your PPP loan has been forgiven and that amount is excluded from income, you can't also deduct the expenses that you paid for from those dollars, right? So the IRS's perspective is that you basically shouldn't be allowed to get the benefit twice, not pay taxes and get a tax deduction. So lots of those in my profession strongly disagree with the IRS. The AICPA and other CPA groups has come out very forcefully asking for Congress to provide additional clarity about what they really meant in the legislation so that everybody can still deduct all of these expenses, because Congress intended people to have essentially a double benefit, which is a good thing. This is still an open question though, and it will probably be an open question for a little bit longer. So this is something for you just to kind of pay attention to through the spring as you're filing your taxes. Because if you got PPP dollars and you wanted to spend them on rent for a studio, if you cannot deduct that, then you need to basically adjust your records for when you file your taxes. But let's hope you don't have to do that. The other thing is all about this PPP forgiveness, right? So far, financial institutions have started accepting applications for forgiveness of those PPP dollars. But if your PPP loan was less than $150,000, and most of the individuals I work with had loans that were less than $150,000, most people are waiting. The Small Business Administration came out with a simplified version of the forgiveness form, which is nice. And then they came out with an even more simplified version of the forgiveness form. And that is for anyone whose loan was less than $50,000. But a lot of people who are paying attention to Congress and legislative action believes there's going to be essentially a blanket forgiveness. So anyone who had a loan of less than $150,000 automatically gets it forgiven. So a lot of people are just waiting for that to happen. Obviously, there's not a lot happening in Congress right now, and it's been a fall where there has been a lot of stops and starts on different initiatives. So stay in touch with your financial institution. They are probably communicating with you about the status of your PPP loan. So if you want to go ahead and fill out the form and get it forgiven, that's probably fine. If you want to wait, that's probably okay too. I don't see any questions in the chat on PPP, but I will pause here just for a second because I'm going to move on to some of the other types of money you may have received. So if you've got a PPP question, throw it in the chat now and I'll try to answer it. The next kind of category of dollars that some people received were sort of like PPP, except we called them EIDL. These were emergency disaster loans that came from the Small Business Administration. Now, these are definitely loans. These are not forgivable. You will not have this forgiven as part of any future legislation, and this is absolutely a loan. So as you're looking at your records and the different dollars that came into your accounts, if you received EIDL money, don't count that toward your taxable income either, right? Because this is just money that has come to you that then you will pay back at 3.75% over 30 years. So a lot of small businesses tapped into these dollars to sort of give them a cash flow cushion, but this is not income, so don't count it as your taxable income to you. Now, you may have gotten unemployment. There are still close to about 20 million people in the United States receiving unemployment, either through traditional unemployment or through the pandemic unemployment assistance that extended unemployment benefits to individuals who were freelancers. So through either of those programs, regular old unemployment or PUA, most states will withhold taxes from those payments. So if you were eligible for a weekly payment of $250, then the odds are good that your state will have been withholding taxes from that payment, right? So that's a good thing to pay attention to. It is also possible you live in a state that did not withhold taxes from your unemployment payments. If that's the case, I would go ahead and look back at what you received because unemployment is taxable income to you. And so you want to make sure you have the dollars set aside to pay any taxes you might owe on that. Now, in addition to PUA, which extended unemployment to self-employed individuals and freelancers, there was also that extra layer of unemployment. That was that extra $600 payment that was coming to individuals through the end of July. So your regular benefit may have been $250 a week, but you were really getting $850 a week because of that extra $600 amount, which is fantastic. Then during the month of July and into the first or so week of August, or I'm sorry, during the month of August and into the first week of September, that amount was paid out at the $300 level through some FEMA dollars that were reallocated. What we saw in a lot of states is that states were not withholding taxes from that extra $600 or $300 amount. But that is still taxable income to you, and you still have to pay taxes on it. So if you were someone who was receiving unemployment, maybe just flip back through your records, see if taxes were withheld, and if not, either because they weren't withheld on the main amount or that extra $600 piece, you'll want to go ahead and have some dollars set aside, just keep them in a savings account so that when you file your taxes next year, if you do end up owing, you'll have the money to pay for that. A question in the chat. What about the EIDL first 1,000 that was supposed to be forgiven? Great question. So for that EIDL program, if you applied for EIDL and then received approval, many people received $1,000 that was just a grant, right? That was just free and clear money. And that is intended to be excluded from income, which is great, right? If you also took $9,000, right? So you may have been approved for $10,000 of a loan. They would have given you $1,000 as a grant up front and then given you the second $9,000 piece if you accepted the terms of the loan. Then you could pay back the $9,000 if you wanted to just get rid of it, or you could just receive your $1,000 and call it a grant and move along your way. That is intended not to be taxable income to you. However, if you also received PPP money, so let's pretend you got a $10,000 PPP loan and you got a $1,000 advance grant from EIDL, your PPP is not going to be forgiven at the full $10,000 amount. It's only going to be forgiven at $9,000, right? Because they'll take your grant amount and reduce the amount that's eligible for forgiveness. So general rule, EIDL, the immediate grant, if you received that, exclude from income, but no, that might reduce your forgiveness amount for PPP. I hope that helps clarify. The $1,000 was based on sort of how many employees were part of the group that was applying. So if you were self-employed, as many individuals were, that's how they were getting a $1,000 grant as part of that EIDL program. If you were a company that had 6 different employees, you could have gotten $6,000. Clarification from Andrea in the chat. Andrea was told by the New Jersey Department of Labor that the $600 was not taxable. So they had the option of having taxes withheld, but then they didn't withhold from the $600 because the Department of Labor rep said it wasn't necessary. Get that in writing if you can, just to sort of protect yourself. My understanding is that $600 is taxable, and there was the option. Some people opted into having taxes withheld, some people did not. It is very possible, depending on when you were corresponding with this person, that, you know, the guidance may have adjusted or changed. And then in terms of how you get it in writing, if this was a phone call, maybe just jot down some notes from the phone call. In a perfect world, maybe you would have had notes during the phone call itself with, you know, the date of the call and those kind of things. But you can always sort of jot it down and write down your understanding right now. So that's not a bad idea. And you know, it was a phone call on August 17th. So that's fantastic. If you also happen to know the person's name, that would be helpful as well. And what's interesting here to sort of unpack is that, as we know, there are different layers of taxes, right? So there's federal taxes, but then also state taxes. So it is very possible that your rep may have been talking only about specific state level taxes. It's also possible that New Jersey took action to do something specific related to these additional $600 payments. In any case, though, I would kind of make sure kind of your documentation is ready to go. Thanks for asking that question. I appreciate that. Okay. So how much should you set aside for unemployment taxes if you were in a state that was not withholding? The general advice is many people were setting aside about 15%. And if you read the guidance from different states' unemployment offices, that's the amount they usually recommend that you set aside. If you live in a very high tax jurisdiction, so a state where there is a high state tax and also maybe a city tax, I might nudge that amount up a little bit, especially if you had income from other sources during the year. So I might think about setting aside maybe 20, 25% or so, just so that you can have that amount on hand. Question from Sergio in the chat. Oh, I'm sorry, question, I think it was maybe Andrea again. What about the SBA grants? So the SBA loan program was the EIDL program. That was this one right here. And then that small piece of the EIDL loan advance is what was treated as a grant. The other SBA program was this PPP program, which was structured as a loan, but then it got forgiven. So those are the two SBA programs that I am most familiar with. If you have another specific one, definitely throw it in the chat because you might be able to jog my memory for another one as well. And Sergio asked about those $1,200 stimulus payments from the CARES Act. Great question. Those are not taxable. The $1,200 check you received, and possibly you got a $500 amount if you had dependent children, that amount is not taxable to you at all. And the way that program was structured, those dollars were structured as a credit on your future tax return. So when you file taxes for 2020, which you will probably do in the spring of 2021, there's going to be an extra line on the tax return that every individual will have, and it says advanced refundable CARES Act credit or something like that, right? And that's where the $1,200 credit is going to show up on your tax return, but you will not be taxed on it. This was designed to be a refundable credit, so it's amount that everyone gets paid back from the government, but it was paid back in advance of when you file your tax return, as opposed to when you file your tax return next year. So great question. Thanks, Sergio, for that. When it comes to the other stuff, everything else is pretty normal-ish, right? If you had a W-2 job, that's taxable. Any gigs you may have had are taxable. If you sold merchandise or music or downloads or anything like that, that's all taxable. If you taught lessons, that's taxable income. If you had online concerts that were ticketed events, that's taxable income to you. If you had online concerts where you asked for contributions, that's also taxable income to you, unless you were structured as a nonprofit or had a fiscal sponsor that received those dollars. So all of these are pretty much normal how we would think about taxable income in music world. What you should be paying attention to, though, especially in moving online, is the potential for sales tax in new states, right? So let's pretend you have merchandise you sell, or you record an album and you sell that, right? Depending on where that's shipped, you might have a sales tax obligation in those other states. I wouldn't really worry about this unless you start having maybe a couple hundred transactions in a different state. Like, let's pretend you have a huge following in Kentucky and you sell, 500 albums there. That's a time you would definitely want to look and see if you have a sales tax obligation in Kentucky. 1 or 2 sales to a different state, I really wouldn't worry about. But it's also possible you have been working from a different location, and this could possibly affect your income taxes for this year as well. We know a lot of individuals have not been going into the office or the school where they may teach or another place of employment. So instead, everyone's working from home. And depending on where you were and where you are, you may have also moved cities or states temporarily or permanently to ride out the pandemic in a different place. So, in a perfect world, this should not end up in you owing more taxes, right? Even if you end up needing to file in multiple places, you shouldn't end up having to pay more, because if you pay taxes in state Massachusetts, but you end up in New York, the state of New York should give you a tax credit for any taxes you paid to Massachusetts. But it's going to be messy, especially as this affects a ton of people this year, and it's going to take a while to sort out. So the advice that many people are giving is to pay attention where you have been. And that kind of means counting the number of days you've been in different places, especially if you moved temporarily somewhere else. So let's say normally you are based in Boston, and for the month of April, May, and June, you moved to a more remote part of the state where your best friend had a house and great Wi-Fi, and you just sort of spent some time there. You would want to count up the days in April, May, and June. What is that? Around 90 or so days. You would want to count the days you were there and just keep that list somewhere, right? Because when you go to file your taxes, or when you have an accountant file your taxes, they're going to need to know where you were, because if you were in a particular place for a particular period of time, and each place defines that period of time differently, you may trigger a tax obligation there. So just something to keep in mind if you found yourself moving temporarily from place to place. The follow-up question when we talk about working from home is typically that now that everybody's working from home, you get a home office deduction, right? No, not necessarily. And this is going to be really interesting this year because there's a big misunderstanding about who gets this and why. But in the arts especially, it's really fuzzy whether what you're doing is for an employer or it's for your own business. If what you are doing is for your employer, there is no home office deduction. In fact, you can't deduct any of the expenses you have out of pocket for a job you have for someone else when you are the employee of someone else. So let's say you have a position with a college where you are paid as an assistant professor or a lecturer or adjunct instructor, and you are paid as an employee, right? No expenses you have associated with that job are deductible to you. But what if, in addition to having that job, you also teach students independently on the side, or you also have performance opportunities on the side, and you use a part of your home in an ordinary and necessary way for your business that's not as an employee, but it's your own business? That part of your home is deductible to you as a home office or home studio expense. The same rules apply as long as it's for your own thing. The space has to be used exclusively and regularly for your business purpose, and you would want to document your use of the space and make sure you are very clear that you're not deducting anything that's associated with a job you had as an employee of someone else. You're only deducting the space that you used in connection with your own business. So definitely pay attention to that. I think we will see, I don't know, deep down, I hope the IRS will be flexible in understanding that this is a strange year. And normally you would only see your own students from home. But this year, maybe you had to do some of your W-2 job at home as well. So it seems reasonable to have some flexibility around that exclusive part of the home studio test. But we also don't have any guidance saying that the IRS is going to be flexible on that. So the general takeaway is anything associated with your W-2 job or a job where you are an employee is not deductible, right? You cannot deduct any expenses associated with that work. You can deduct expenses associated with your own business or your own practice. So I would encourage you to make sure your records are showing clearly how things are supporting your own business. And if you are working from home, right, keep that space separate. One question that came up in advance was about other business expenses that may have come up this year. Specifically, someone asked about studio rent going away, which is good, right? But this person is paying referral fees. And the question was, are these deductible? And the answer is yes. In general, if you pay referral fees, those are deductible to you. That is an ordinary and necessary business expense. There is some extra guidance to make sure these aren't really bribes or some sort of kickbacks that are disguised as referral fees. But as long as you're not bribing someone, it should be totally and completely fine. What I would suggest is when you do pay someone a referral fee, ask them to fill out a W-9 for you. That's that form, you're probably familiar with it. It's the request for taxpayer identification information. And so that's when, if you're paying someone money, go ahead and get a W-9 from them. And then if you pay them more than $600 during the year in referral fees, you would send them a 1099 at the end of the year. There's a question in the chat, and it's a private question, so I won't share whose name it is, but the question is it true that home office can only be deducted if there is a profit this year? No, that is not true. However, when you look at Schedule C, which is where your home office or home studio will show up, you have the income at the top and then lots of expenses. And then the line for home office is way down at the bottom. And it is impossible to kind of hide this deduction with other rent you might pay for an outside studio or anything else. So we consider this item an item that draws additional scrutiny from the IRS, because it's hard to use a space exclusively and regularly for your business and to have it be your primary place of business, all of which are required to claim the home office deduction. So you may claim the home office deduction. You do not have to show a profit before claiming it, right? It is a valid deduction that you are permitted to claim, but it may draw some additional scrutiny. So if you are someone who is like, you know what, it's not worth it to document this and jump through all the hoops, I'm not going to worry about it, I think that's probably an okay decision to make. There's a publication from the IRS called Publication 583. It's called Starting a Business and Keeping Records. And they have a great discussion in there on documenting home office or home studio expenses. So if this is something that you are in the habit of claiming or want to explore, I'd suggest reading up on it just to make sure you're comfortable claiming it. And yes, Natasha, I sure can. It's Publication 583 from the IRS, and I'll put it in the chat just so you can see me typing it as well. It's called Starting a Business and Keeping Records. You're very welcome. Okay, so some people also got emergency grants. So we had the PPP and EIDL dollars that ran through the Small Business Administration. We had unemployment that was running through the states, including those additional payments, right? But then there were also emergency grants. Now these are separate from that $1,200 stimulus payment, right, that Sergio asked about, totally separate. These emergency grants often came through community foundations or maybe your city arts council. Artistrelief.org ran a huge program, and these were emergency grants awarded or given to individuals who were struggling because of the pandemic. So the question is, are those dollars taxable? And if you are a tax geek, this is a very exciting question to answer because it's really interesting. If you are a regular human, it is very annoying that there is not a clear answer to this question. It kind of depends on the wording of the grant, whether or not these dollars are taxable. I think if you're going for a general rule, it's probably a good bet that any emergency grants you received are not going to be taxable. I think there's a good bet that that will be the case, but it kind of depends. So here's why it kind of depends. There's a section in the tax code called Section 139. And this section specifically excludes qualified disaster relief payments from income. So if you have a disaster and you receive a qualified disaster relief payment, that's not taxable to you, right? So that's great. We like that. That's probably good. Because President Trump declared a national emergency, almost everything related to these emergency grants we think will count as this Section 139 emergency income, right? So governmental relief should probably not be taxable, but if you received a grant and the wording of the grant was something along the lines of this was replacing other income you had, then that might be taxable to you. So in that case, it's not an emergency grant because of the pandemic, it's replacing other income you may have had. So let's take an example. Let's pretend you are someone who was affected by the pandemic. You saw an opportunity to apply for emergency relief. You applied, and it was a city arts council that gave you a $500 emergency grant. And it said, you know, gosh, we know times are tough. Here's a COVID-19 emergency grant of $500, right? That feels pretty clear that it's under Section 139 and not taxable. But what if instead you were booked to perform at a festival and the festival got canceled? And the festival organizers reached out to you and said, hey, sorry, we're canceled. We won't be able to honor that contract, right? Here's a $500 grant to kind of make up for the fact that we couldn't pay you for that performance. That doesn't really feel like an emergency grant. That feels like something that is replacing income that you lost because of the pandemic. And I know this kind of feels like a distinction without a difference, but this matters in the eyes of the IRS. Almost every funder I have talked to intends for the grants they have awarded to be excluded from income under Section 139. And almost all of them are trying really hard to get their tax advisors to sign off on that, right? So if I were betting, which I would not do, but if I were betting, I'd say probably any emergency relief you got should be excluded from income. I think there is a small chance that some of it might be considered replacement income and taxable, but almost all of it, I would bet, would be excluded from income. There's a question in the chat. This person got an emergency loan from a credit union, interest-free, and paid it back in 3 months. Must you claim that? No, that does not sound like taxable income to me. That sounds like an emergency loan that then you paid back and you had no interest expense on it. So that feels like just what we would call like a balance sheet transaction where you're trading an asset, cash, for a promise to repay and then repaying it. So that does not feel like it would be taxable income to you at all, which is a good thing. So as you're doing your math about figuring out what your income might be for the year, count that as cash that you got and then paid back, but I wouldn't count it as income. Another question in the chat, do the SBA $1,000 grants count under Section 139? Yes, those should be excluded from income because those were emergency grants and they're flowing through the government. So it's pretty clear that that's going to comply with Section 139. Phew. When it comes to some of these emergency relief grants as well, including the SBA EIDL advances and any dollars you got from your state arts council or a city arts council that probably came down from the NEA through the CARES Act, right? I would definitely make sure you are keeping really good records about what you spent those grants on. Most of those dollars originated from federal sources, and there were a whole lot of dollars flying around. And it would not surprise me if we see a whole lot of audits of those federal dollars in the next year or two. Now, I'm not talking about a tax IRS audit, right? The IRS will get around to it. That's fine. I'm talking about these federal and state agencies auditing their records and saying, okay, we gave this person $1,000 and it had to be spent on payroll expenses or emergency equipment or something else. Then they will look as part of an audit to see if the recipient of those dollars spent them in the way they were intended to be spent. Now, we also know it was a crazy global pandemic and still is, right? And people were struggling to make ends meet. People were being laid off. There were medical emergencies happening. Things were chaotic, right? So if you received emergency dollars and then just spent them, that's okay. Now, though, if you are at a place where things are a little bit calmer, it's a good time to gather some of your records and say, okay, I got $500 from this emergency grant and I was supposed to spend it on studio rent. So make sure you have a receipt that shows you spent $500 on studio rent, right? So that's the kind of record keeping that you can do now to make sure that you're accounting for the dollars that you received. It's okay if that actual $500 was spent on groceries and then you spent a different $500 on studio rent, right? That's okay. But definitely make sure you are pulling your records together to show that you spent the money on the emergency relief that you needed to spend it on as part of the grant. Question in the chat about whether you have to do this for that $1,200. No, you do not. The $1,200 is just totally free and clear money. It's not enough totally free and clear money, but that is just totally free and clear money. So you don't have to worry about any documentation for that $1,200 stimulus payment. You do have to worry about it, though, for PPP grants you got, or for any sort of emergency relief grant you got for your state arts council or anyone else. I would also go ahead and do it for that $1,000 EIDL advance you may have gotten. I would go ahead and keep the records for that about what you spent that on. The EIDL program was not as restrictive as PPP, which is a good thing, but those were still federal dollars flowing through. So it still could be subject to some questions from the Small Business Administration. So keep the records for EIDL grants. EIDL loans, if you're going to pay it back, you could do whatever you wanted with that money. Keep the records for PPP and then any other grants you got as sort of emergency relief efforts. That's where you need to focus on keeping those records. And ultimately, the questions that these individuals or organizations will be asking are, are you claiming the same expense and saying you're funding it from two different sources, right? That's what they're looking for. They're looking for basically individuals that may have claimed a double benefit from these different dollars. I think it is the percentage of people who did that is probably zero or next to zero, but this can be a really stressful situation. So if you've got a moment of calm right now, it's a good time to kind of pull those records together. So this is kind of how I might suggest doing it. If you did receive an emergency grant and you're working under the assumption that it is not taxable, maybe go ahead and just note which of these expenses were paid with that emergency grant. And this doesn't have to be fancy. It can be on a sheet of paper or in Excel, or if you have QuickBooks, or if you use Wave or something else. All of these platforms have different kind of notes features where you can kind of say, you know, rent for studio in June paid with Massachusetts Arts Council emergency grant or something like that. And that's okay to do. So that's a lot of information. What does it all mean? Remember, we started way back at the beginning saying, okay, is your taxable income going to be higher or lower than normal this year? And then most of the work is figuring out the answer to that question. And if your net income is going to be higher, what we want to think about is maybe making some contributions toward retirement, because that is something that can bring that taxable income down. If you have the flexibility to think about the timing of certain expenses, that might be something you want to think about. Maybe you're instrument could use a tune-up or a professional level cleaning. If that's something you wanted to do in December instead of January or February, that means you would have the deduction for that in this year instead of next year. And if you're looking at your numbers and you're saying, okay, my income this year is higher than normal, maybe I want to do it this year so that I can have that deduction. You can also, especially if you have higher than normal net income, you can think about what does it look like to invest in your business? Do you need a new website? Have you been, planning to purchase a new instrument or a new piece of equipment for a long period of time? Maybe now's the time to do that if your net income is a little bit higher. So these are the things we would be thinking about if your net income is higher than normal this year. If it's going to be lower, which is very normal for many people, we definitely want to make sure you have pretty good records in place, especially if you are going to have a loss this year, meaning your expenses are greater than the income you brought in, which again is very common this year, especially for performing artists who were hit among the hardest of the creative individuals. If you are in this situation, keep really good records. Make sure you're documenting your expenses, you're making sure you have a business purpose for each one, and you're paying attention to your cash flow. You're making sure that, you're kind of managing as best as you can. Maybe you have reduced some of your expenses as much as humanly possible. And you can also think about some timing. So that instrument repair that could be now, or maybe you could wait another 2 months, maybe you decide to wait another 2 months and push that deduction into next year. So these are kind of the year-end management things we start thinking about, depending on whether or not you're going to have higher or lower net income. Now, I mentioned retirement and setting aside dollars for retirement. One of the questions that came in advance was, is now a really good time to be thinking about investing? And this person shared that they had read some articles that said to wait, other articles that said invest now, and they were just feeling confused. I get it. It is super confusing. And I will remind you, it is both always and never a really good time to think about investing or retirement, because investment includes inherent risk, and you will never have perfect timing to buy when something is at its lowest price and then sell when it's at its highest price. So because we can't predict anything perfectly, we go back to some kind of fundamental things. You can afford to be riskier if you have a very long time. So let's pretend you're in your 20s and you are thinking about saving for retirement. And for you, retirement means maybe it's going to come in your 60s. We would call that a relatively long period of time. You maybe have 40 years or so before you're going to need that money you are investing. So when you have a long time, you can afford to be riskier, because if you invest and then the market crashes, you still have more than 30 years to let the market kind of recover, right? And some of you have seen this in your lifetimes, right? If you think back to 2007 and 2008 and 2009, we saw what most people call a market crash when everything then recovered. And now things are higher, or the indices for investments now are generally higher than they were just 12 years ago, right? So we've kind of seen this in action, and yet it still feels very uncertain. The other times you can afford to be riskier with your investments is if you have a high volume of assets, or if you have an okay appetite for risk. And these are all things you can decide for yourself, how comfortable you are with all of these things. Question in the chat: if you normally claim a loss and have not been eligible to contribute to a retirement account, I assume nothing has changed in that regard. That's correct. And it sounds like you might be talking about one of those SEP IRA accounts, or one of the other retirement plans that's specifically tied to your business. Because for those types of plans, you have to have positive net income to make a contribution to your retirement. There is another option though, an individual retirement account or an IRA that doesn't have anything to do with a loss in your business. So let's say you had another source of income, or maybe someone else in your household had another source of income, and you are looking for additional ways to reduce your overall taxable income. An IRA contribution is still something you can think about, even if within your business on Schedule C, you had a loss. But you're right, nothing has changed with respect to the plans that are tied to your business. A couple of things we know to be true right now, interest rates are pretty low. That means if you are thinking about buying real estate, it's not a bad time to buy real estate. If you are thinking about saving money in a savings account, you're not going to be earning a lot of money on the amount in that savings account because interest rates are really, really low. The other thing we know is that the long term is a really long time. So if you are thinking about kind of an overall plan for 20 years or so, then I would still say, it's probably still an okay time to invest. If you're thinking about a long-term plan that ends in 2 to 3 years, I would be more conservative about investing right now. It always makes sense to think about things in the big picture and have some sort of disciplined strategy, and to invest in a lot of different things so that if one industry is affected more strongly than others, or if one company is affected more strongly than others, your entire portfolio won't kind of come undone. I would also say, if you're listening to all of this and you are saying, no way, I'm not investing in anything, I think that's crazy, that's okay too. It is perfectly fine to leave your money in a bank account, a savings account, a money market savings account that might pay a little bit more in interest. And if you're looking to do some good, you can look for a minority-owned bank or some other financial institutions that could really use some extra capital. So if you want to have your money just hanging out in a savings account, finding a minority-owned bank in your community is maybe not a terrible place to let that money hang out. All of our financial institutions, both banks and credit unions, are insured by the FDIC or the NCUA. So any balances up to $250,000 are insured by the federal government. So there is no risk for you keeping your money in a checking account or a savings account, as long as it's an FDIC insured bank. If you want to go deeper into retirement and you're kind of looking at the numbers and you're saying, maybe I could set aside $5,000 or $6,000 this year in an IRA. There is a great retirement calculator by a company called NerdWallet. NerdWallet does, they provide great tools that are really fantastic for personal finance and personal financial wellness. And you can play around with their calculator and kind of see what some of your options might be. So if you look out of all of this and you're like, okay, let me do this, you have some different options when it comes to your retirement. If you have a W-2 job, so you are an employee of someone else, you may have access to a 401k or a 403b account. If that's the case, I would say go ahead and participate in your company's plan or your institution's plan. 401k is for for-profit companies, 403b is for not-for-profit companies. So if you work for a nonprofit college or university where you teach, or you have an administrative job with an orchestra or a symphony, odds are you might have access to a 403b account instead of a 401k. If there is any free money, so they are providing contributions on your behalf or they are matching your contributions, take advantage of the free money, right? We like access to free money. And if your employer has a relationship with TIAA-CREF or Vanguard or Fidelity or any of these other companies that will sort of set up these plans, you can kind of take advantage of having access to them through your employer and think about your retirement that way. Another option is an IRA. That's that individual retirement account. For this, you can contribute about $6,000 per year. This amount is tied to inflation, so in general, it nudges upwards a little bit. And if you are an older individual, you can make an additional contribution. We call them catch-up contributions. So, this could be an option as well. This is your individual retirement account. It's not tied to an employer at all, but it basically works the same way. Then if you have self-employment income, so you have a Schedule C where you report income from freelance jobs or teaching or anything else that is entrepreneurial and like self-employment, if you have positive net income there, you may start a SEP, a simple, or a solo 401k. And as you heard me mention earlier, you do have to have positive net income on your Schedule C or on your self-employment tax form to have access to these different options. But as you're looking at all the different types of income you may have, you might find that having a combination of these different accounts might make sense as well. Question here, if I sold property out of necessity because of the pandemic and will be paying capital gains on that sale, does that qualify for a retirement account? It wouldn't qualify for any of these SEP, simple, or solo 401ks unless you are in the business of owning real estate, in which case it might. The character of it being probably a long-term capital gain might kind of change that a little bit. But if that's not something you do as a business, it's just something you do as an individual, then that probably wouldn't help you for a SEP or simple or solo 401k, but it could help you with an IRA for sure. And the other option as well, assuming you have some cash that you're able to invest, is a Roth IRA, which works very similarly to a traditional IRA, but the tax situation is flipped. So in a traditional IRA, you get a tax deduction right now in the year you make the contribution, and then everything grows tax-free, and then you pay taxes when you take the money out. For a Roth, it's opposite. So you receive money, you pay taxes today, and then you invest the money in a Roth IRA, but then it grows tax-free, and when you take it out, there are no taxes because you paid them in the original year. So as you're looking at all of these different options, it's important to kind of think about all of the different types of income and deductions that you might need in total. And saving for retirement is not a bad strategy just in general. But remember, as we're thinking about these things, we are thinking about them from the place of, my taxable income might be higher than normal this year, so I'm interested in getting that down. So if that's not necessarily true for you, or if you're feeling like you might want to keep some money a little closer on hand because you're not quite sure how long it's going to be before things return to normal or the next version of normal, it's okay to just sit on the money too, right? Just to keep it in your savings account so that you can use it throughout 2021 as needed. So as we're talking about these potential retirement accounts, right? After you choose which one you want, 403b or IRA or a SEP, usually the next question is, okay, now that you've got this, what should you invest in? And this is where sometimes people get thrown off a little bit because it feels like a really complicated question that does not have a simple answer. And that is true. It is a complicated question without a simple answer. I am not telling you to invest in this fund by any stretch of the imagination, but I wanted to show an example of a mutual fund that you could choose to invest in if you were to open, say, an IRA this year. And I wanted to draw your attention to a couple of things that you can pay attention to. If you go onto, say, Fidelity's website and open an IRA, you might feel overwhelmed by the number of choices you have. So instead of feeling overwhelmed, look for a couple of things. Every fund will have a symbol, right? We call it a symbol. Usually it is 4 or 5 letters that will be kind of the call signal for the fund. It will also have a title. This one is called U.S. Sustainability Index Fund. That tells me a couple of different things. It tells me it's a US-based investment. So most of the investments will be based in the United States, as opposed to a global sustainability index fund that might have investments outside of the United States as well. This word sustainability always gives me pause because I always wonder if that is marketing of a fund rather than defining sustainability in the way I would define it. But then this also tells me it's an index fund. So this investment is going to track some existing index that exists in the world. So the fees will probably be lower because the fund is designed to look exactly like a pre-existing index. Every fund will have this overall rating from Morningstar. More stars are better than fewer stars. You can also get a quick snapshot of the return of the fund. That's how much money it has earned relative to how expensive it is to invest in the fund. Every investment comes with fees, and generally speaking, index funds have relatively low fees. This will also give you a snapshot of risk early on. Again, things that feel more aggressive will live over here. Things that feel safer will live over here. Depending on you and how long you have before you might need this money, you can decide whether your investment should live in the green space or in the orange or red space. Every fund will also show you a graph of its performance over time. If you just kind of glance at this, we see it started out kind of lowish. This is way back in 2017, so like summer of 2017, and then it has gone up over time. But it hasn't gone up every single moment over time, right? In fact, we see a moment here where the value fell from what, 14,800 or so down to just under 12,000 or so. That's kind of terrifying, right? When you think about a big number turning into a smaller number. We can see that then it came back up to that bigger number, but I think it's important that you understand that there can be some pretty volatile movements in these investments, even though we think of index funds and mutual funds as being relatively safe. They can still be pretty volatile. Every fund will also have some sort of paragraph that describes it in words. This is hard to read sometimes. I'll draw your attention to a couple of things. This tells you what index it's tracking. So if you wanted to read more about what the MSCI USA ESG index is, you could Google that and learn more. This is telling you about 80% of this fund is invested in securities or stocks as opposed to bonds, which is kind of interesting. This tells you it focuses on US companies, and it focuses on companies with high environmental, social, and governance performance. That's that ESG piece. That's all well and good and very interesting, and you can dig into each of those terms to see if you're comfortable with that. Or you could look at the fund's top 10 holdings. Every mutual fund you will investigate or poke around and read about will probably show you its top 10 holdings. These are when you take money and put it into a mutual fund, then the mutual fund invests in other companies, right? These are the top 10 companies the fund has invested in. So as you're looking at this, you see that this is about a third of its total portfolio. That tells you that 31 and some change % of its assets are in only these 10 companies. That's a good thing to know. And you can glance at these companies and see if they're ones you are comfortable investing in. Sometimes looking at the top 10 holdings gives you a better idea of the fund than a verbose description of the strategy, right? So looking at these top 10 holdings is always a good idea. And then once you see it, you can make choices. You can say, oh my gosh, I think Home Depot is a great company. I love that they're invested in Home Depot. Or you can say, you know what, I'm not really comfortable with that. Their values don't align with mine, so I don't want to be in this investment. And then you can make a choice from there. Student loans. I'm switching gears on you again, right? I'll pause just in case there are any retirement questions. I haven't seen any more coming through the chat, but I'll keep an eye on it just in case. Another question that came through in advance was about student loans. So I wanted to spend a few moments touching on some of the changes in this area. If you have student loans, your interest on those student loans has been set to 0% since March. Originally, this came from the Department of Education, And then it was enacted as part of the CARES Act. And then when that provision expired, there was an executive order that extended 0% interest on federal student loans through December 31st. So that means your federal student loans have not been accruing interest since March, which is a good thing. Your payments were also suspended. So you may not have been making payments on those student loans, which is also a good thing, especially for individuals that didn't have the capability to make payments, especially if they lost jobs or performance opportunities or other things like that. You can keep making payments during this period if you want. That is perfectly fine. You may have to reach out to your loan servicer to make that happen because automatically payments were suspended. But if you're someone who says, you know what, I want to go ahead and make payments, especially right now while nothing's accruing interest, that's perfectly fine for you to do as well. As you think about payments restarting, which is scheduled to happen on January 1st, be prepared for those payments to restart and, dust off some of your paperwork and see what your ongoing payment might be and make sure you have the funds available to pay that. And I would direct you for more information to studentaid.gov. They have a great sort of write-up of the various coronavirus programs that paused everything. So that's a good resource. And as you're thinking about repayment options and whether you want to keep them the same or pay a little bit more or pay a little bit less, studentaid.gov has a loan simulator calculator kind of program. So you can enter your information for both federal and private loans and then sort of finagle some of the math to see what you might be comfortable with. Question in the chat. What if we continue to pay our loans? They continue to automatically take them. Do I need to check on anything with that regard? So it was only federal student loans where the payments were suspended. So if you had a loan through a private company or if it was a private student loan, that wouldn't have been affected by any of these sort of accommodation measures. But if you had a federal student loan and they continued to take payments, I might go ahead and peek into that just to see. The good news is that you made payments toward principal, if that was the case, instead of toward interest, which is a good thing. But I would say the difference is probably the private loan versus the federal loan. All right. I'll keep my eye on the chat just in case there are more questions about student loans or retirement or taxes or anything else. But now that we've sort of hit on some of the major things to think about as we approach the end of the year, I think it's also interesting to take a moment to say, what if this keeps going? Most of the individuals and the organizations I'm talking to do not expect anything will go back to normal anytime soon. We know performances will be one of the last sectors of the arts industry to return in full force, but we also know that music is projected to continue to rebound in some way, shape, or form. That does not mean everything will be back to the way it was in 2019, but we do see some changes on the horizon. And we see organizations that have been resilient and have adapted and will probably continue to embrace some of the adaptations they've made. So as you think about what if this keeps going, I'd encourage you to take some time to do two things. Get really clear on your value and then identify opportunities to maximize that value. So what do I mean by these? If we were doing kind of a full-blown entrepreneurship course, we would be talking a lot about your unique value proposition. And that is a term that drives many of my clients crazy because it feels businessy and entrepreneurial-y, right? And I get it. But your unique value proposition is basically your unique strengths that add value and how you're going to use them to add value, right? So if you just kind of think about each one of those words instead of all of them as a thing, you can spend some time getting really clear on the value you provide, both how it has changed and also how it has not changed. Music and performance has always been a way of uniting the community and a way of bringing people together. And it still is. even though we're not bringing people together physically, but we are bringing people together virtually. Music is still bringing joy to lots of individuals as they are working from home. It's bringing calm to people who are feeling unsettled. It's acting as a release for individuals who are feeling anxious and stressed. There are so many wonderful things about the value of what you do that have not changed, but some things have. You might be teaching students virtually. You might be performing virtually. You may have not traveled since March of last year. There are lots of things that have changed and some things that haven't. So I would encourage you to get really clear on both what has and has not changed for you specifically based on your craft, your discipline, and your overall place in the industry. Because then you can have conversations with potential clients and customers and other individuals about the real value of what you do and how it has gotten better or remained the same and continued to provide the same quality that it always has. And then it's also helpful, if you're really clear on this, to use it almost as a litmus test to identify new opportunities that might exist. And that's where we shift to a perhaps optimistic moment here. Americans for the Arts has been doing amazing research pretty much this whole year on the impact of COVID-19 on individual artists and arts organizations, right? So I would encourage you to check out their dashboard. It is fantastic and full of amazing information. One of the data points that I honed in on is this idea of how artists get paid. So I think there have been about 60,000 artists across the country who have responded to this questionnaire so far. And overwhelmingly, artists make money from individuals. They make money from a lot of different categories as well, but there's a lot of individuals that give money to the arts. So this could be in the form of lessons, this could be in the form of people taking classes, this could be in the form of people buying tickets, right? So many different options here. And I think it's really interesting to go into each of these areas and think about who is in these different categories and how can you add value for them, or which of your strengths do they need specifically right now. So when it comes to individuals, this is, I think, a big area for opportunity. And I don't have to tell you this because many of you already serve a lot of individuals, but it definitely takes time to build the audience here. And it's interesting to think about what individuals might value at this moment in time. We aren't going to major performances together, but we are having family happy hours via Zoom or other smaller group events where you could think about, what does it look like if a chamber group does a small performance with some intimacy for 20 different individuals on Zoom or something like that. Now, that might make your stomach turn if you've seen some of the performances I've seen where the audio is bad and the timing is off and it's just kind of crazy. I've seen some wonderful ones too that work really well, but you can think about kind of what the opportunities are. As you think about students who are in remote schooling, that presents an opportunity to do remote lessons to complement their curriculum that is otherwise not really being fulfilled, right? Particularly when it comes to music in some areas. So this is not going to solve the whole problem, but I do see some interesting opportunities here. I also see some interesting opportunities to cultivate an ongoing membership or Patreon type of support from your most ardent supporters. Individuals are getting more and more used to paying ongoing subscriptions or support for different things, including the arts. And so I think it's interesting if maybe you have a following or you have a newsletter list you have built up over a number of years. What would it look like to explore some sort of Patreon or membership-like thing where you could collect revenue from those individuals on an ongoing basis? I'm not talking about, $30, $40, $50 per person per week or anything, but what if it's $3 per person per month? What would that look like, right? So it's really interesting to kind of explore that. We also know that individuals make money from for-profit companies. The green section of the bar here, this lower part, is creative for-profit companies. So production companies, different music companies, architects, graphic design firms, et cetera, et cetera. But then also this top part is non-creative for-profit businesses. And we know some of them are doing okay right now. We also know the US is in a recession, right? But it's a recession that's rebounding and is probably rebounding in economically unequal ways. So if we think about the industries that are doing okay, it's healthcare, it's logistics, it is financial services to a lesser extent, right? So there might be opportunities there. What would it look like for your chamber group to partner with a logistics company and provide a concert or musical lessons or relief to its staff or something like that, right? So thinking about the value you're providing and matching that with for-profit companies that have the means to pay for that right now. And of course, many creative individuals make money from nonprofits. We know that is going to rebound, but it's going to take a while, especially because nonprofits are looking at the same data we are looking at. And they're looking at governmental funding that's probably going to be cut, especially at the state and local level. They're looking at corporate funding that is leaner and leaner, foundation funding, and individual giving that may have shifted away from the arts and toward other social service nonprofits, for example. So it will come back, but it might be slow. With that, I will pause. There's a question from Wayne in the chat. Hi, Wayne. What is my opinion of the following? One of the great problems is many artists are giving away their services in exchange for visibility. One of the things we don't discuss is the overflow of content. And while some people are charging for their services, there are just as many who aren't. This will cut our bottom line for the future, not to mention weaken those who are union people as they will have less bargaining power. Do I have thoughts on this? Of course I do. I absolutely do. I am not a fan of giving things away for free, just as a general rule. I understand the inclination, right? Because again, there's so much value that music has, or the arts have more broadly. And as giving, creative, empathetic individuals, you want to provide that value. And I think that's a powerful, powerful inclination. And it's a good inclination, and I want to support it. But I also want to make sure we are capturing the real value of the arts, because they have tremendous value. And one way to capture the value is to take a more European model where the value is recognized at kind of the societal level and supported through public dollars so that everything can be provided for free. That's not what we do here in the United States, with a couple of exceptions. Generally, what we do is have some public dollars supporting the value, but we're also asking individuals to contribute to the value. And so for me, I think it's a matter of not saying, do we do something for free or do we not, but helping everyone understand the value of what they're receiving and looking for opportunities to capture that value. So I'll give you a couple of examples. A lot of the free things we have seen have come from people who have very, very strong, healthy financial circumstances that enable them to do something for free, which, as you point out, undercuts someone who might not be in that position. We also sometimes see it from someone who is trying to break into the industry and looking to gain experience, or someone who is an amateur and looking to do a free concert or something like that. I think there's a moment to kind of hit on the sweet spot of capturing the value of what we do. And I know I keep saying that phrase, but this idea that, okay, I can't compete with the most famous musician who's giving a free concert via Zoom, right? And will probably be attended by 20 million people worldwide. I can't compete with that. And I might not want to. What I might want to do is focus on the 25 individuals that I can provide an intimate musical experience for, who would all be willing to pay or exchange something of value for that experience. So that's where I think the real magic is. It's honing in on the key audience who values what it is you do, however you describe it, and then capturing that value, whether it's through an ongoing membership model, or whether it is through a ticket exchange, or whether it is through partnering with a nonprofit and splitting the proceeds 50-50. Follow-up question, when someone offers you an unpaid gig and tells you it'll be good exposure, remind them that people die from exposure. I love that. It's very, very true. And also, I think it's so interesting that if my appendix were to burst right now, I would never dream of going to a hospital and saying, you know, I talk about taxes for a living. Why don't you take out my appendix for free and I'll give you great exposure next time I talk about taxes? That's insane, right? We would never think about that. But for some reason in the arts, we have to continually remind people of the value of the arts. So even if a surgeon loves taking out appendices and derives great joy from that professional experience, it still has value, and we exchange value in this country through money, right? So I think that's fascinating. And there are plenty of online forums where you can find fantastic discussions on working for free and why to not work for free. So thank you for raising that question. What other questions do we have? We still have about 4 more minutes. I'm not seeing anymore. I also don't have like dots showing up to see if someone is still typing. So I will remind you of our outcomes and also keep an eye on the chat. So if you're mid-question, keep it coming. We wanted to focus mostly on current status of COVID-related assistance, which is a big question mark, and planning proactively for the end of 2020 with a transition into thinking about going forward and what that might look like.